you.
All right, Jason, take it away. All right, good morning, everybody. Again, Jason Russell, branch manager, Caliber Home Loans. We are here today to do our Q2 finance forum. And if you were here for the marketing meeting, you got a little taste of what we're hoping to do today. We have a fantastic local realtor, Joe Lynch, who is joining us, and I'll introduce him here in just a moment. And our goal today is we want to just talk about appraisals. Obviously, there's a lot going on, not just with turn times, but also just, you know, the market going crazy, values coming in where they're coming in at, wanting to do reconsiderations, lots of stuff going on. So we thought it would be helpful if we brought everybody together, and we'll do a little moderated discussion to start, and then we're going to open it up for questions. I'll monitor the chat, and we'll do an open forum once we get through a couple of questions to start. So again, we have Joe Lynch. He is not just a local appraiser, but he's also an affiliate here with us for Northern Solano. So Joe, do you want to introduce yourself, tell us a little bit about your background, and we'll go from there.
Sure. Last check, I was the only appraiser affiliate for Northern Solano. I'm also, I live in Woodland, and I'm an affiliate with the Yellow Association of Realtors also. Past president of an appraiser association in Sacramento, and I'm on the corporate board governing for REAA. We have another North Bay chapter, an East Bay chapter also. I teach classes to other appraisers, primarily in market analysis, trend lines, the technical aspects of appraising. I got my start in 2002 in Fairfield, working for a lady who appraised apartments. Worked for her for 6 years, and then in 2008, I went off on my own. I am a graduate of Vacaville High School, and also a graduate of UC Davis. Go Ags, go Bulldogs. I have extensive experience with Solano County. I've done thousands of appraisals in Solano County. So that's kind of my background.
Awesome. So again, thank you so much for joining us and listening to our questions and kind of helping us get in a good place so we're all serving our clients that much better. So let's start with a question in regards to the market as a whole. Obviously, right now there's tons of folks who are offering over asking right now on listings. How are appraisers, or should they be handling this situation where people are coming in over asking and trying to, you know, determine where that value is going to be at?
So it's a difficult thing. First of all, what we're supposed to value is, or come up with, is market value. That is different than market price. So the price that a buyer and seller agrees to is market price, it's contract price. Market value for lending appraisals is based on a definition of value from Fannie Mae and Freddie Mac. And it's the typical buyer who wants to buy the property, as opposed to the highest bidder for a property. So the difference, and as realtors, you're all commission based. So you're in favor of highest price paid financially, because it's in your best interest for the transaction to be as high as possible. So that's part of the reason why we have appraisers in the first place. I don't care what the value is. I just, you know, I have no financial interest at all. I just want to do my job right and come up with what I can support. So in a situation where we have you know, pretty much all of Northern California and most of the U.S., there's very low inventory, very low interest rates, very low supply, and very high demand. So that's driving prices up. That's leading to multiple offers. In some cases, that's leading to multiple offers way over initial list price. And in some cases, that's way over past sales. And then it's our job to determine, is that really above what the typical buyer would pay for the property? Or is it a bidding war and it got bid up and got to an artificially high price as opposed to what the market would support? And that's really difficult. It's a hard thing to do. There's some tools that we can bring to the table. One is time adjustments. So if prices are going up, every appraisal should be considering time adjustments for comparables. They should be making positive time adjustments in this market. They did a review about a month ago. It's Browns Valley property. It had 4 model matches on it, and I picked up the review. I don't do much review work, but I figured 4 model matches in Browns Valley, it's probably a pretty easy review. And it turned out the appraiser called it stable. You know, prices are not going up, they're staying the same, and he made no time adjustments. And so, you know, unfortunately, there are some folks who, in my industry, who don't know how to do their jobs right. And this guy clearly did not know how to do his job right. And so I hammered him on the report, on my review, sent it back to him saying, hey, you need to put time adjustments in. Here's a graph showing that this place is going up. You know, this market's going up 150 bucks a day. And you're not making any time adjustments. You got comps from 5 months ago. That's wrong. So that's a significant tool that better appraisers can use, is time adjustments, to show what's really happening in the market. In extreme cases, we can contact agents for homes that are in contract and use that information to help us further confirm time adjustments. And so I realize that you have an obligation to your clients for confidentiality, but if there's any way that you can give us hints, if an appraiser calls, hey, I'm doing this sale, you're in contract, can you tell me about where you're at? That gives us more evidence to support market adjustments over and above what maybe is out there. If it's a case where the best comparable is in contract and 5 people, you know, made an offer 20 grand over list price, that's pretty good evidence that that 20 grand over list price is market value for that property.
So that you brought up a point that I think is an important one, and correct me if I'm wrong here. So one of the things that we as on the lending side sometimes see is we'll get, you know, an appraisal will come in short, the listing agent will want us to do a reconsideration of value, and I'll say, hey, I need some other comps. Can you provide me some data to go back to the appraiser with that supports the value that you're looking for? And a lot of times they'll come back and provide pending sales. And so what you're saying is those pending sales can help with the time adjustments more than let's use that as a comp per se. Am I hearing that correct?
So it's supportive evidence. You know, Fannie and Freddie Reds are somewhat fuzzy about the use of pending sales, homes in contract, in market conditions like this. So there's room for the appraiser to put more weight or to include that as evidence to support a market adjustment over and above what would, you know, necessarily would make. That said, a lot of lenders, a lot of appraisers look at closed sales as the golden ticket of evidence for, you know, to support a value. So to a certain extent, there's training issues in our industry, but at the same time, there's a little bit of fuzziness from the lender guidelines, excuse me, and also from lenders themselves. Investors don't necessarily want us to use contract prices, even if we do confirm them, because they've not closed. And so there's a potential that if we hang our hat on one home in contract and it falls out of contract, then we have nothing to hang our hat on, and 6 months later, we could be screwed by the state if we overappraise something. So there's a yin and yang type thing that's hard to balance. And, you know, it's difficult.
Yeah, and I think that's a great point because, you know, one of the things on the lending side is we get the appraisal back, and of course an underwriter has to go in and review that appraisal. And if you do get, you know, a particularly, you know, stickler underwriter who is, you know, looking at it and might see a pending sale as a comp, or, you know, this thing is way overvalued and they just start getting out of their lane, all of a sudden, you know, you could get a request for a desk review where we have to have a second appraiser come back in and take a look at the original appraisal. And then you've got opinions coming in. And to Joe's point, if you get someone who has some training issues that could, that's doing that desk review, you could run into some problems based on that value. So yeah, the underwriter certainly plays a part in all of this as well.
And it does. And in my experience, local lenders with local staff have a tendency to be more in touch with what's going on in a specific market. So, you know, if you've got something where you know that potentially the value is at the top end and maybe even above supportive value, if your lender is the low price leader national lender, that's not a good place to be and potentially setting you up for fail. If it's a local lender who understands local real estate markets, hires the best appraisers, will give appraisers the amount of time necessary to do a proper analysis, then you're giving yourself a better chance to actually complete the transaction. And it's really important for difficult, unusual properties for you to pick your lenders carefully to make sure you're using someone who has a panel of appraisers who can do the difficult properties. So, you know, if your buyer insists on using the national mortgage lender that is the low price leader who can turn it as fast as possible, that potentially will set you up for fail. So that review I talked about, the appraiser saw the house, typed up the report, and turned it in the same day. So he was clearly cranking through work, trying to maximize his income and not trying to maximize the quality of work. And if you're going with someone that doesn't use, you know, better quality staff, you know, you're going to run into issues potentially.
Awesome. So, you know, talking about, you know, providing the best information possible. So assuming it's the listing agent that's going to meet you out there for the appraisal inspection, or, you know, that's who you're talking to up front. What kind of information would be ideal for that listing agent to arm you with to make sure you have as much data as possible to make a good determination with?
So first I'm going to start with training. Some appraisers have been trained or have taken on the attitude that if I talk to a real estate agent, a listing agent, for a purchase that I'm working on, that I have to be careful not to be influenced by this agent. So they, in my opinion, will overreact to data provided by listing agents. So some in my industry, we all have E&O, we've all been warned that the state will come after you if you're influenced. And so they overreact and will not talk to an agent about their listing. I am on the opposite fence. I think that it's best if I know everything at all about the property and that I try and take in as much data as I possibly can. So regarding a specific listing that I'm appraising, I want to know what's been done to the house. So give me a list of all of the improvements done in the last 15 years. How was it marketed? So where did you position this? Who did you see as potential buyers? What are the positive aspects of this house? I'd love to hear you guys tell me, hey, what's an issue with this property? Reasonably, if it's an obvious issue, I'm going to find it. But I certainly understand that it may not be in your financial best interest to disclose everything, and you may want me to work harder to find out that issue. But please, it's great when everyone's honest. So the next thing I always ask, how many offers were received? As an appraiser, I'm supposed to report back on the contract details, and part of that is an analysis of why the specific contract was picked. So why did your buyers select this offer? Why? What else was received? You got 25 offers. They range from X to Y. There was a clump of 5 offers right around the same price. We picked this one because of strength, because I use a local lender, because I like the agent on the other, whatever. You can give us that. That helps us build a story of what's happened with the property. It helps us better support a conclusion of value. What else? If I'm open to listening to sales data, I want to make sure that I don't miss a reasonable comparable for my subject. I've done that in the past, and it's very, very embarrassing. I want to know ahead of time what are the comps that are reasonable to use for this property. So what a comp is it's a substitute for the subject. So what's sold in the last 6 to 12 months that a buyer for this house would buy instead? It's not based on a motivation of coming to a conclusion of value higher than anything else before. And so I do that by comparing my 2,000 square foot house to an 800 square foot house and saying, hey, this price per square foot on this 800 square foot house supports my price per square foot on this 2,000 square foot house. That's something that unfortunately I see frequently and is bogus, because someone buying an 800 square foot house is not buying a 2,000 square foot house. Two different sets of buyers. So think about, what is a direct substitute? What's on the market that's a direct substitute? Now, the people who came in and saw my listing, what other listings are they looking at on the same day? Give us that evidence, and some appraisers were going to look at that as that you're trying to potentially influence them to come to a conclusion of value. But if you present it in a case, hey, these are what I think are substitutes for the subject. You're welcome to do them or to do with it as you will, but I think this is similar to the subject. And try not to say or even think about, hey, these prices support my value. Think of, hey, this one is really like mine. The same pool of buyers bought this one or would look at this one as look at mine. Those are the types of sales data that's very helpful to an appraiser. And my friends, the ones that have been doing this a while, most of them have the same attitude. They don't want to make a mistake. They don't want to miss something. And so they're welcome. They welcome the data. I think you guys might hear some cat scratching, so give me a second. I'll be right back.
And so Joe's bringing up a great point there in terms of the data that you want to share. From the lending side, we try to do the same thing with an underwriter, right? We want to go into an underwriter's as they open our file and give them as much information as possible to make a decision. we want you guys as realtors to start thinking the same way when it comes to the appraiser. It's not because I want to sway an underwriter's decision on whether or not my loan is a good one, but I want to arm them with as much data and information as possible so that the underwriter can make a good determination on whether or not this loan should be approved. It's the same thing on the appraisal side. You want to provide as much data as possible as to how you came to your belief on where the value is on your end. So Joe, I've had appraisers tell me in the past, so you brought up a point about the idea of square footage and a buyer for that particular type of house, right? An 800 square foot buyer is not going to be the same as a 2,000 square foot buyer. How does that play into, say, for example, you have someone who has a 4-bedroom, 2.5 bath at 2,500 square feet versus someone who has a 3-bedroom, 2-bath, but the same 2,500 square feet? Does it matter in terms of how those homes are laid out, or what that particular owner wants to do with that space as far as the value? So I guess the short part of that question is square footage the important factor, or is the bedrooms, bath kind of layout a more important factor?
So when I'm pulling comparables, I want to match the square footage or at least bracket it as much as I can. And then same with bedroom count, same with bath count. I want to show support and evidence for my adjustments, whether positive or negative, for superior or inferior features. And with sales comparison, the way to do that is to have sales of properties that are on both sides of the subject. So as far as your question regarding bedroom count or square footage, which is more important, it all depends. It really depends on the market, depends on the buyer, depends on what's available. In a conforming neighborhood like Browns Valley, I'm probably going to find plenty of sales of 4-bedroom homes and 3-bedroom homes, and so I don't need to consider both. In a country property on 20 acres in Winters, there's been 5 sales in the last 12 months, and so I'm really limited in what data is available, so I'm going to take a wider glimpse at what a potential buyer would buy. A 20-acre property outside of Winters, I'm going to look at Dixon, I'm going to look at Vacaville. It's a different market analysis because there's so few properties that sell. You go to a highly conforming neighborhood like Browns Valley, you've got 30 sales of roughly similar homes. That's a different problem, and you can narrow it quite a bit.
Which brings me to my next question. When you've got, say, for example, a Browns Valley area, when you're talking about how far out you want to go with comps, is it quarter mile typically when you've got, a built-in subdivision type area? Do you half mile? I mean, is there a general rule of thumb that we would want to stick to for not necessarily your country property where you've got to expand that out, but for your, neighborhoods that were all built in a similar time frame?
So it's the theory of substitution is the basis for residential appraising, and it's what's a substitute. So if I'm in Browns Valley, I generally search all of Browns Valley. I want to grab everything that a potential buyer would consider in Browns Valley. So I'll go to the hills, I'll go down to Markham, I'll go to the airport, I'll go, depending on what the property is, I'll go to the north end of Browns Valley where the new homes have gone in. And I'll look at everything in there. And then once I have that bigger set, I'll narrow it down. Then I'll look at homes of similar age. I'll look at homes of similar size. Generally speaking, for pulling comparables, you want to start a little bit smaller to quite a bit bigger. And the thinking is that if a home is a little smaller, the buyer potentially could use it. But the buyer could make use of a home that's quite a bit larger. So, maybe start at 10% smaller to 15% larger in square footage, or 15% smaller to 20% larger, something like that. Something else that I do, I look at 12 months, every appraisal. I start with 12-month search. And then after I've done my 12-month search, if I'm in a conforming neighborhood with 100 sales, then I'll shorten it up. Then I'll look at 6 months. Once I have that pool of smaller group of sales, then I'll start looking at the most recent sales. Then I'll start looking at the model matches. Then I'll start looking at the ones that are most similar in quality and condition and so on. And the idea is start with as many possible, and then to make sure you're not missing something, and then shrink the pool to a smaller and more similar group as you know more.
Awesome. Got a couple of questions in the chat. One from Melinda. How do you consider a converted garage in, say, those older homes in Fairfield where most of them seem to be covered? Positive or negative?
Melinda, why don't you go ahead and take yourself off mute? Did I get that right, Melinda?
Melinda.
I'm sorry, Melinda.
What I meant to say was where most of those older homes, they've converted the garage into, say, a bedroom. So instead of a 2-1, it's now a 3-1, or 3-1 now becomes a 4-1.
So I recently did one in Fairfield that was like that, where the garage was a 3 2.5, and it went to a 4 2.5 with no garage. And couldn't find any permits with the city. Really nicely done. It will depend on, first of all, underwriter guidelines. So some underwriters or some lenders have less concern regarding garage conversions and unpermitted changes to homes. Others are very sensitive and don't want to deal with it. The one I did was for US Bank. They gave me rules that I had to play by, but basically it was a high quality garage conversion, and would be accepted as living space by a typical buyer. So I included it as living space. I mentioned that there were no permits found. This put the size of the home at the top of the neighborhood range. So it went from being a 1,600 square foot house to a 2,000 square foot house. Looked at a big wide neighborhood. I found one sale of a 2,000 square foot house in the last 12 months out of, I think, about 300 sales. So that led me to make a smaller than typical gross living adjustment, because it was a super adequate house. It was over improved on the size. But for the typical home where you convert the garage, it's pretty well done, it's functional as a bedroom, and it's within the normal range of size in the neighborhood, and there's other sales of similar homes. You go back 12 months and you can find 5 of these conversions, then that's good market evidence that it's accepted. The thing to be careful of is whether it was done safely. So if it really is a bedroom, is there 2 ways of getting out of that garage conversion to the outside in case there's a fire? If there isn't, it's not a bedroom. So you need a window, you need a door, whatever. But there needs to be 2 safe ways of getting out. Second question is the quality reasonable and similar to the rest of the home? If it's a step down in quality, then it may not qualify as gross living area, it may qualify as something else. Maybe a garage conversion that needs to be pulled out and changed back to a garage. Is that kind of what you were looking for, I'm hoping?
Yes, and then I guess also what I was wondering is, and I don't even know how to say this right, do you, as an appraiser, prefer to see it as a garage, or it's okay as a bedroom? Does that make sense?
It all depends. So first of all, it depends on the neighborhood. Now, is it a neighborhood where there's a lot of garage conversions and it's pretty accepted? So if that's, so south of Armeo in Fairfield, there's the States, like East Tennessee over that area. There's a fair number of garage conversions there. It's pretty widely accepted. If you go to Rancho Solano, garage conversions are not accepted. It's not normal of the market. If I'm in Rancho Solano, don't want to see a garage conversion because it's going to be a pain in the ass for me to figure out. It's going to be a difficult assignment. And honestly, it's most likely going to be an adjustment to remove the garage conversion because a typical buyer wouldn't want a garage conversion in Rancho Solano.
Yeah, those state streets are exactly what I was talking about.
Yeah, exactly. So over there, you know, I would warn folks ahead of time that here's a garage conversion, you know, buyer to verify permit, something like that, little breadcrumb in MLS to say, hey, there's something unusual here and you should research it. That first of all tells appraisers like me that here's a comp potentially that has a garage conversion that was not permitted. It's valuable evidence when we get that one when we run into it, like I had a couple months ago. Second, it gives listing aid or buyer's agents a little heads up that, hey, potentially this is not as straightforward as typical because there's this garage conversion we're going to have to sort out. And if the lender can deal with it, then it's good. If the lender can't deal with it, then it may be one to pass on. Does that help?
That helps a lot. Thank you.
Sure.
All right, next question from the chat in regard, kind of similar in regards to ADUs. So obviously we've got a lot of folks that are building ADUs in the backyard, either for Airbnb or for family, elderly folks that have moving in, kids that won't get out of the house, whatever the reason may be. How are you looking at those? Are you looking for similar houses that have ADUs and comping out from there? What's your thought on them?
Yeah, exactly. So if I do an appraisal with an ADU, a property with an ADU, then I want some market support for how much the ADU is worth. So I'm going to look for comps that have ADUs. In some cases, it's reasonably easy to find. Like Davis is starting to have a fair number of ADUs. Sometimes it can be difficult. I did one in North Vacaville that was almost an ADU, kind of an ADU, and Jason might have even been for you guys. I think it was for Caliber. It was on Fruitvale, and it was really difficult. I struggled to find some data, but eventually I did. I think between you and the earth, don't tell the owner, I think I probably undervalued the ADU aspect a little bit, but I focused on the rest of the property, gave them a lot of credit for it. So it's one of these things, as appraisers, we're starting to talk about how to figure out how much these things are worth because it's becoming a lot more prominent. We're seeing a lot of them in Sacramento County. There's a lot of places where it's an answer to housing shortages. Throw an ADU in, you can have tenants. Some markets don't allow for rental occupancy of ADUs, but many of them do. And I think we're going to start to see a lot more of them. Costs on these things are insanely high right now, just like all building. I'm hearing down in the Bay Area, people are spending $200,000, $300,000, $400,000 on their ADUs. So $200,000, $300,000, $400,000 on a 1,000 square foot addition to your property that's detached, that has a kitchen. But if your property is worth $2 million and it's a 3.2 Rambler from 50 years ago, then I guess that's equity you can pull out and just drop it on it. But yeah, it's one of my mentors is saying that we've done a poor job as appraisers in valuing these things. And I'm starting to pay closer attention and looking to see when I can support a higher value than I have in the past.
Awesome. Edwin, does that answer your question? Cool. Next question in the chat, what kind of adjustments do you make for solar? And I think it might be helpful if you...
I pull them out of the sky.
Specifically, I would say owned solar, not leased solar per se.
Right, so that's the first thing you need to do is classify what type of ownership it is. So if it's leased or a purchase power agreement, it's not permanent property and is not given value in vast majority of appraisals at this time. So first question is, let me see the contract. Is it PPA? Is it leased? Then, assuming that it's owned, we look for comps. The issue with comps, sales comparables, is it's less of an issue with sales and solar panels on them. We're seeing more and more homes selling with solar panels as they become more widely adopted. But the issue is the data provided. So there's a difference between a 2 kilowatt system and a 10 kilowatt system. A 2 kilowatt system saves you, 50, 75 bucks, 100 bucks a month, something like that. 10 kilowatt system saves you $300, $400, $500 a month. So knowing the system size is key. So when you have a own solar system, please put in the MLS notes the size of the system in total. Second is depreciation. It's really important to know when these things were installed. So a 10-year-old solar system has depreciated at least a third and maybe half. A 1-year-old solar system has not depreciated maybe 5%. So that's also a significant factor. So you can include the year it was installed, the age of the system, then that helps us figure out to a finer degree how much to value it. Third is you can use a online service called pvvalue.com, and of course the cat's on my mouse, so I can't really easily type right now. But pvvalue.com, you can sign up for an account. You put in the address of the property, you put in the ownership, you put in the size of the system. They want you to put it in watts. So if it's a 5 kilowatt system, they want you to put 5,000 watts. And then they want the age of the system and the age of the inverter. And then they'll use cost analysis, income saving analysis, and they'll kick out a number. I use that number as a high point for residential lending. If I'm out in the country on acreage, that number is usually fairly similar to what my adjustment is going to be, because I see if you're on small acreage residential, you've got 20 acres and you've got an orchard and you're pumping water and all that, people are paying more for owned solar systems than they are in town. In town, I see that as the top value, and I usually am down from that. Out in the country, I see that as a pretty good starting point for an adjustment to make.
Awesome. Next question, aside from pendings, where can agents go to determine time adjustments?
I'm a MetroList subscriber. I'm not a Barry subscriber. MetroList has a tool that I think Barry's has called Trend Graphics, Trend Vision. Do you guys have that available?
Yes.
It's a great tool. You can use that. You can do it by zip code. You can do it by MLS area. You can filter for size of homes, and then it will show you trends over whatever time period you set. And you can do a monthly change. You can do, year-over-year change, and that will help you with time adjustments.
Perfect. And next question from Ophelia, can an FHA appraisal be challenged? Is it official once it's generated? Certainly, I'm going to guess there's the opportunity to do a reconsideration of value, but Ophelia, do you have any specifics you want to share, and maybe we can answer it more specifically?
I do. I have a current listing, and FHA appraiser called for a window that is in the master bedroom. It's built in 1955, and the model is same like kind on the street. However, this window is rectangular shaped and a bit high above all the other windows. So appraiser came in and said it does not meet egress, and would like that to be corrected. Seller said, no, I'm not going to correct that, as the window is like kind across in this block. So I pulled up on the MLS another property that has the same window, and it did sell on an FHA loan. So, yeah.
So in that case, what I would do is call the local building department and ask them to give you a ruling on the safety of that window in that bedroom. And FHA guidelines state that local building code overrules. So if it meets local building codes, if the building department will sign off and say, yes, this is good, you can provide that and provide that to the lender, and then the lender can use that as evidence for overriding the appraiser. The underwriter for FHA always has the ability to override the appraiser as long as it meets FHA guidelines.
Okay.
Yeah. So what I would do, get that building department letter or whatever regarding the specifics on that case, and have them, if they consider it safe, then provide that in writing to the lender, and the lender has the choice of either passing it on to the appraiser and then the appraiser making a change, or they can override the appraiser. In my experience, the vast majority of the time, they're not going to override the appraiser because that opens them up to liability. And one of the important features of having an appraiser is passing on liability to the appraiser. So that's why we make the big bucks, is so we can hang our E&O out there for people to sue. So, yeah. The other way of tackling this issue is to call HUD directly. There's a HUD hotline for real estate professionals. I think it's 1-800-CALL-FHA. You can become a registered real estate professional on their hotline, and you can talk to someone specifically about the issue, and they will give you the guidelines. You give them the property, they'll look up the case number, they will specifically apply, provide you with what the rules are, and but so as a caveat, even though there's this 600-page manual, and these guys are all professionals and they do this on a full-time basis, you don't always hear the same story from HUD when you call and ask questions. So take copious notes as to who you got it from, the date, and so on. So if in the future someone says, that's not true, then you can refer to your notes and say, this is what I was told on that day. So there's been cases I know of where the story from one advisor from HUD is one thing, and it's something else from someone else.
1,000,000%, that's exactly what I was about to say, is that make sure you take down the person's name that you spoke to, the date, the whole thing, because as any lender on this call will attest to, it just kind of depends on who you get when you call the HAWK.
Yeah. So, it really does, and HAWK is Home Ownership Center. Ours on the West Coast is in
Santa Ana.
Santa Ana, thank you. I knew it was Santa something.
What was that number again? 1-800?
I think it's 1-800-CALL-FHA. Jason, can you look that up?
Yeah, I'll get that and put that in the chat.
All right, thank you.
My cat's
It's already in the
flat.
chat.
Oh, okay.
Perfect.
Oh, there you go.
In the chat.
FHA Connect, that's it, absolutely.
Awesome, thank you.
Yeah, no worries.
And to answer Josh's question in regards to whether or not you can have an appraisal waiver or not, I'll just take that because it's kind of a EU question, and Joe, feel free to chime in. But
sure.
On a purchase, you will not get an appraisal waiver with less than 20% down. So your first thing is going to be making sure that your borrower is putting 20% down. There are some caveats in there in certain areas that FHFA have identified that they'll let you might trigger one below that. It's pretty rare to get one. So that would be number one. You have to have a 20% down buyer. The other piece that comes up is it just comes down to data, right? So the desktop underwriter DU, which is what Fannie Mae uses as their automated underwriting system, basically is reviewing all the appraisals they have on file in the area and determining whether or not the value that the loan officer has entered as the value for our property is reasonable enough to not require an appraisal be done. So they're getting more and more aggressive with those in approving them, but there's a lot of buyers that come in that don't have 20%, and that's going to be off the table right out of the gate for most of them.
There's other factors, whether it's a conforming home or not. So if you're in Cape Valley, don't expect to get a waiver necessarily because there's no data. If you're in Browns Valley, you're much more likely, Fannie and Freddie are much more likely to have more data available to figure out how much the house is actually worth. If there's a recent appraisal on the subject for, say, a refinance, they load that into Fannie and Freddie, into DU, and that gives them more information for their processing to help them understand what the value is. So that's another factor.
How recent would you say on appraisals? I mean, for refis, how recent?
So EU started in 2012. So they've put every appraisal they've received since 2012 into the system. Clearly, the more recent the appraisal, the more likely that it's going to match what they're seeing or what the house is today. But so before 2012, those appraisals didn't get loaded into DU.
Yeah,
I appreciate it.
Yeah, that's a huge point. Is the more rural properties you're going to get, there's just not data enough to make a determination. And going back to just if you're doing a regular appraisal, you're going to have to go look further out, and because the properties aren't as cookie cutter, so all that goes into play when determining whether or not we're going to get a waiver. Karen, I see your question. We'll get there in just a minute. I'm sorry, Joe. Go ahead.
Yeah, if the property is unusual and in town, that's another reason why you may not get a waiver. So if it has an ADU, then potentially that would be a flag for not providing a waiver. If it's, to think of an example, in Suisun City, next to the harbor, there's some mixed-use properties. So those are good candidates for not getting a waiver. If it's just atypical, that's typically where you run into trouble.
And the same thing with the more aggressive that you're going to be with that value, right? If you've got multiple over asking, offers, and you guys went way over what the comps may support, we're not going to get an appraisal waiver for those either. Joe, what's something that you see as a common thing that agents can do ahead of time to avoid subject twos?
So there's several things. Let's talk about first of all lending appraisal. In California, there needs to be a carbon monoxide detector on each level that has a bedroom. Bedrooms need to have smoke detectors. Needs to be smoke detectors in the hallway. Hot water heaters are supposed to have 2 straps unless they're tankless. If there's a tank, 2 straps. There's a couple of minor exceptions to that, but basically, if it's a 25-year-old hot water heater, at the time code was in place, You didn't have to have straps. I think there might be one or two 25-year-old hot water heaters that still work, so that's probably not a good exception anymore. I have seen one, I saw one about 5 years ago, where it was a 25-year-old water heater and worked great. It didn't have straps. And I just took a picture of the data manufacturer and included that in the appraisal, and lender didn't care. It's not really a safety hazard if the house doesn't have gas. The whole point of having straps is for hot water heaters that have gas, if there's an earthquake, so they don't move and break the gas line and cause the house to blow up. So if it is an all-electric house, if it's an electric hot water heater, I don't consider it a safety hazard not to have straps. But building code doesn't distinguish between the two, and some lenders don't really care, and they're going to require the straps. Other lenders don't mind. So CO, hot water heaters, smoke detectors. FHA is different than conventional. There's a whole host of stuff that we check. Basically, if it's there, it's supposed to work. So garage openers, appliances, what else have I seen? So heating and air systems, we'll check those. Also, exterior surfaces for FHA are supposed to be sealed. So if there's any bare wood that's not like treated redwood, if it's like chipping trim, that needs to be painted or primered ahead of the appraiser coming out. What else do we frequently call?
Anything like exposed wiring?
Yeah, exposed wiring. Yeah, exactly. Exposed wiring is a good one too. That's another one we're supposed to look for and call as a safety issue. And then getting back to windows, if I see a window that has cracks and I think a child could reach that window, I call that as a safety issue and require it to be repaired. If it's displaced with jagged edges, I call that as a safety issue. If it's a pane that's cracked, but it's out of reach of a child and it's not displaced, I mention it, and I don't necessarily call that a safety issue. If it was FHA, it would definitely be a required repair. If it was not FHA, the underwriter may or may not require it to be repaired. That's personal choice. Other appraisers may have a different take on that. If they see cracks, they may just call it to be repaired.
Okay. Karen has a question similar to that, and Karen, you may want to jump off mute to ask it specifically, but appraiser calling for a door to be installed, access to an addition. Addition was done with permits and given to the appraiser.
Hey, Joe. Karen.
Hey, Karen. Hey. Yeah, I'm good.
Good. So Joe, this is my experience on a listing I had where they added an addition and it was added to the wall of the family room. And it was all done with permits to the city of Dixon, signed off. And so when the appraiser came, handed all the information to that appraiser, when we got it back, they estimated a cost to add a door of $5,000 and made it a condition that it had to be done. So of course the seller was, I don't understand, I did it the right way, and now I'm required to do something. So we did go back and try to communicate with the appraiser. It didn't work. So
the lender accepted this as is?
So no, we couldn't move forward with that particular appraiser. We ended up switching lenders, got a different appraiser, and he called nothing. So that's kind of frustrating for a listing agent, right, and a seller if you're getting an appraiser requiring something that we feel should not. So I guess I'm just throwing it out there, and I know as you just made a comment, it really depends on the appraiser as well on how they see a home and what they want to call.
Yeah. So to me, that's a story that I don't like hearing because it makes us look stupid and petty. If the building department in Dixon and they're sticklers, if they signed off on a permit, then it's pretty suspect that an appraiser would say, I'm requiring something more than the city building department. I call BS, and I wish I knew who it was, so I couldn't refer that person any work, because that's doesn't sound right. It's pretty ridiculous, if you ask me. So I'm sorry that you had to go through that. Unfortunately, training's uneven. All of our industries are like that. We've got some. Yeah, I'll stop there.
So I guess here's another question for you, Joe. How do you advise us as agents? I mean, what can we do? I mean, we called that appraisal company, and I don't remember at this point, was she or he with that appraiser company? They never returned our call, Joe. Never. We couldn't even discuss it, or maybe she missed the files up with another one.
Was it FHA or VA or was it?
It was conventional.
Yeah, so I would just work through the lender. By working through the lender, they're the ones who are going to approve the loan or not. And so they're also the one to pick the appraiser. So I would, work with if you're the listing agent, you got to work with the buyer's agent and the loan officer to try and sort out issues like that. That's the proper process. And Jason, you probably could speak more to it than I could, but if a listing agent calls me randomly, I'm going to say I can't discuss this because I have confidentiality with my client lender. Go talk to the lender. The lender calls me and says, hey, what's the story here? Then I'm going to talk to them. So as appraisers, this is something I haven't mentioned. We have confidentiality with the lender. So without written permission from the lender, we can't talk to anyone else about our appraisals.
Yeah, and to Joe's point earlier, it is one of those things where a lot of times underwriters aren't going to want to stick their neck out and make a judgment call. But I always coach my loan officers that, hey, let's go up the ladder here and let's see what we can do. And that is one of the benefits of your local lenders is we've got local underwriters and people we've built relationships with, and it becomes much easier to at least get a sit down with an underwriting manager or above to get to somebody who might be willing to make the judgment call. And from what you described, it sounds like you have plenty of evidence to potentially make that a reality.
Yeah.
Okay, we're running a little short on time. I do want to answer Dave's question in regards to lenders offering different appraisal prices on job boards. So yeah, I've been hearing this a little bit. We at Caliber, we just raised our appraisal cost to the borrower by $50 to try and get more appraisers being willing to pick up our orders. It's just one of those things where it's supply and demand. Joe talked earlier during the marketing meeting about how many orders are on his desk and everybody else's desks right now. And, money solves a lot of that. And I've been hearing some things from other lenders that are guaranteeing appraisals in X amount of days, and they're paying what needs to get paid to make that happen. There's certainly some strategy to that I think, if this continues moving forward, that a lot of lenders will start to think about doing. And I kind of talked a little bit about that during the marketing meeting as far as having a buyer that's willing to pay $200, $300, $400, $500 to pay for a rush, and a rush being a normal time frame appraisal. And if that's just what it takes, it's what it takes. So Dave, you want to add to that question at all?
Hey, Joe. Hey, I think I'm unmuted, right? Joe, thank you so much for coming here. You and I have bumped into each other a number of times, over the years, and you're a really awesome guy. And you know what? Thank you for showing up, because usually most of you guys are just so busy. You guys are on spin cycle, but this is a point of contention now for me that I have learned that now that we have as realtors, we work on commission and we have different rates and it's not set, but now we have appraisals in it, and it feels like the appraisal is supposed to be the stopgap in the value of the property, and now the appraisal situation is becoming where it's become a competitive market, and if I'm an appraiser and I'm getting more to be paid on this job, I might be more favorable on this job or less on this job. So I just had that. I just had one. Matter of fact, I had to jump off this call to take the appraiser call after 15 days. I got finally the appointment for the appraisal. And the lender said over and over again, we couldn't get anybody to pick up the appraisal until we raised the price up $200. And I mean, that really comes to me and really hits me in my core and say, wow, that's really crappy. You know, I mean, it doesn't serve the public. And I know you guys are underpaid already anyways, but still, not having some standard, especially after, you know, CFPB did all this stuff back in the days with AMCs and everything. It just seemed like a lot of the integrity of the entire appraisal industry got lost. You know, there's only a few of you guys left that really do it. This last year, I've had some doozies that show up, and I'm like, I don't even know how you ever got a job as an appraiser, right? And it's just horrible to see it, but this difference of where we're picking up jobs and we're bidding up now appraisal jobs on a job board, to me sounds like, you know, it almost sounds like a violation to me in a way of something, because it goes against what exactly happened with AMCs, where appraisals were supposed to be made on a more fair playing field, and then there wasn't any direct contact. So what do you think?
I'm not sure I understand your point exactly, but let me go ahead and explain kind of how I operate, and maybe also talk a little about the industry in general. So first of all, when I get varied with work, I raise my fees to reduce the flow coming in and to make more money. So I'm a businessman like everyone else.
Right.
And this year I got varied with work and I bumped my fees up, and I was charging $500 for something pretty simple. I'm now charging $600 for something pretty simple. And I still have more work than I can do. The second thing for me personally is when I bid a job, I bid it based on the amount of time I expect to spend on it. So if it's a conforming tract home, I have my base fee $600 right now, and that's what I put out there. If it's gonna cause me to think at all, then I bump it up, and I bump that based on how much time I expect to put in. I had recently, as kind of an extreme example, I had a 8,000 square foot house on the Garden Highway in Sacramento, and it took me 2 hours to walk through and measure the place, while a normal house would take me 30 minutes or less. It took me 30 miles to drive my comps. It took me 3 times as long to type it up. Plus, I had higher risk. So that job I priced way above what my normal fee is. And it was all based on how much time. If I do a country property, I know that it's going to take me longer. For driving, it's going to take me longer to figure out the comps and the adjustments. Plus, I'm at higher risk of problems in the future, so I charge a bit more. You know, so that's kind of, you know, personally how I operate my business. As far as what's going on today, where we have a shortage of appraisers, Freddie Mac put out a graph back in December that showed that the number of appraisers doing lender work over the last 8 years has been about 45,000 different people over the last 8 years. And volume has doubled and tripled in windows. And it's the same 45,000 people who are serving that volume that's doubled and tripled. And so, you know, it's supply and demand. You know, you guys know how real estate works. It's hot or cold, and you got to make money while you can, because when it slows down, hopefully you've got a nice big lot in the bank to live off. And that's kind of how it is for us appraisers too. It's real up and down based on interest rates if you're doing lending. So the other way I personally have decided to protect myself is to move away from focusing on lending. I do probably more private party work than I do lending work these days. Last year I did more lending work, but right now the balance has shifted back to doing more private party work. So I do divorces, I do estates. I help people who can't figure out how much to list their house for. I will do pre-listings, that type of thing. So that diversifies myself so I can kind of weather the ups and downs of interest rates. For folks who don't diversify and all they do is lending work, they got to make bank as best they can. And then as far as different prices for different appraisals, there's all sorts of ways that appraisals get out in the market. You mentioned AMCs and the regulation changes from 12 years ago. So first of all, the change was a requirement that anyone involved in getting a commission from a loan being produced could not have a hand in hiring the appraiser. And the whole point is to protect our independence. Thank you. It's to protect our independence. And so lenders like Jason's company have set up a pool of appraiser coordinators who work with the appraisers and place the orders. However, sometimes their panel can't accept an order on a timely basis. Say they need it back in 2 weeks and everyone's buried. So then they go the next round and they send it out to an appraisal management company. These are companies that sit in between lenders and appraisers, and they have larger panels of appraisers, and they usually have nationwide coverage, and they offer appraisals to their panel of appraisers. They take a percentage of the fee, typically between 20 and 30%. In some cases, 50% of the appraisal charged to the person goes to the appraisal management company. So us appraisers, we don't like lenders that use appraisal management companies that skim this income from us. Also, we don't like having a set of bureaucracy in between us and the lender, which means we have two sets of bureaucracies we're dealing with. So in general, we prefer not to work with AMCs. I don't work with that many AMCs because it's just, first of all, up until very recently, they haven't paid the same as direct lenders. And then second, they're kind of a pain in the ass to deal with because they have a lot more rules than lenders do. But if you can't place it with the lender, then you go to an AMC, they farm it out. The fee goes up when it goes to an AMC because the AMC needs their charge. Some lenders, and I don't think Caliber is one, but I do know that some lenders will send an order out to multiple AMC panels at the same time to try and get an order placed, especially now when they're struggling to get an order placed. And in that case, then you're going to start seeing different fees because all of these AMCs have different fees for how much they're willing to pay. Then you've got competition who can get it back the quickest, who can, get the fee the lowest and so on. And so you see different fees going out into the market because of that. I've had lenders and AMCs shop me an appraisal order multiple times and have multiple fees. And it's really just a matter of, who is going to get the order placed. Jason, does that match your experience?
Yeah, absolutely. And the thing I would just kind of add to that is, to your point, Dave, is if we want to have a flat fee of $550 for an appraisal, we can get an appraiser to pick it up. The problem is they'll be like, I can't get to it for a month, which that's not going to be an option for our transaction, right? So then at that point, we have to start casting a wider net to find out who will take it. And to Joe's point, I have done that where it's like, okay, here's our regular fee. Did we get anybody to pick it up? No. Okay, let's add $200. Can we get someone to pick it up now? And then I've had them, especially in like really rural areas, where I'll just go, can you just tell me, name the price? What's it going to cost so we could get it done? So there's a lot of that. And I think to Joe's point, it's just a supply and demand issue. And we can, and I don't know how much you want to go into it, and given that we're a little over time, Joe, and I want to respect that of you, but just so the group knows how hard it is to become an appraiser, you've got 150 hours of coursework. You've got, 2,000 hours of shadowing. That's a year at 40 hours a week. And you have to find somebody who's willing to, be your mentor in that way. So it's not an easy role to jump into, right? Because it takes some sacrifice up front, which is hard for a lot of folks.
So, hey, Jason, so now
Sorry, go ahead, Dave.
Okay, so now we've like another layer has been added to what we do, right? And as a realtor, I work more on the listing side of real estate, right? So I screen lenders usually when buyers bring offers. So now I feel like now I'm going to be adding some other layers of questions when I talk to lenders. Normally I ask them, how they qualify their buyers and blah, blah, blah. Now I'm going to be asking them, what kind of a panel of appraisers do they have in their company and how, and things like that. And I'd love to see, Jason, I would love to see some sort of a set of questions where we can kind of make that uniform to I'm going to say the word interrogate, but I mean, when I call to question a lender about their buyer and what else do I ask them? Okay, you've got the buyer approved, but there's another layer here. What questions would I ask them about? Can you get an appraisal done now? Tell me how many appraisers you have on your panel. Tell me, where you're working with and what you do, right?
Yeah, man, I think Joe gave you some good questions to ask in that, I think most appraisers will prefer to work for a company that has a panel because they're going to get 100% of the fee. And then from there, figure out, are you working with are your appraisers on a panel? Are they through an AMC? If they are through an AMC, how many are you working with? And, most loan officers will tell you what the average turn time is on an appraisal for their particular company. Some are moving a little faster than others right now. And, the other thing that I would just say is that getting the buyers to sign their disclosures so that we on the lending side can order the appraisal sooner rather than later can shave 2 or 3 days off of the overall turn time, because we can't even place the order and ask until those loan disclosures are out, signed back to us, and we obviously need a contract to do that. So the quicker that on the agent side we can get the RPA in hand and really start working and emphasizing with those buyers how important it is to sign those disclosures ASAP so we can order that appraisal ASAP so we can start that clock in finding an appraiser to go out there is really, really important.
Can I make one comment to that too, Jason?
Yeah.
Sometimes I think especially too when contracts are coming in or being written on a Friday with those 12-day time frames, just realizing that lenders have to get fees from title in order to disclose, and then, essentially rush our borrowers to, sign those disclosures with all their fees and terms of their loan. So, really just being strategic on writing those contracts. When I'm writing, if you're going to write a contract on a Thursday, Friday, Saturday, Sunday, keep that in mind, when a lender, you're already 3-4 days into it by the time we are able to order an appraisal in some cases.
That's a great point. I mean, if you guys think about it, a 17-day contract that's executed on a Friday, 6 of those 17 days are weekends. And so you're asking the lender to pull off an 11-day close, and obviously we need an appraisal in that window. So all of that, it goes into play for sure. All right, Joe, I really appreciate it. I want to respect your time. I'm so grateful
for
you taking the time. Yeah, so.
No, well, thank you. I appreciate it. So a lot of my work is referral work for private parties. So if you have someone who needs an estate appraisal, if you know someone going through a divorce, if you're struggling with figuring out a list price, these are things that potentially I can help with. Also, I need real estate agents to talk to me in order to do my job correctly. If I call up and say, hey, what happened here? This feels like it sold on the high side, or was there some issue because it feels like it sold on the low side? That honesty is needed for me to do my job right. Because of that, and Karen can mention, because Karen calls me all the time, please give me a call, and if I can help with questions like what we've had today, I'd be very happy to take a moment and answer them if at all possible. So, please keep my name and number, look me up on the NSCAR website, I'm there, and I'll be happy to help if I can.
Jason and Joe, can I ask a really quick question? What kind of, we can't talk to an appraiser. They say we can't talk to an appraiser. Can they talk to an appraiser or not?
The loan officer, the person who's receiving a commission, cannot speak to the appraiser. So you typically have a middle person involved. You have an appraisal coordinator that works for the lender that is actually having the discussion with the appraiser directly.
Thank you. Thank you.
Yep.
And non-commission. They do not get a commission, their salary, and so they don't care whether the transaction closes or not. Well, Jason doesn't get paid unless the transaction closes. That's the importance. And then as far as realtor interactions with appraisers, don't try and influence us to overlook things. Don't try and influence us to hit a price. Try and provide information and data. If you take that, hey, here's some information that might help. If you take that approach, it's going to be a lot more than, hey, I need you to come in at this, or otherwise it's going to go away. So, keep in mind that we have a different role than you guys. And I understand that your role is that you need a sale to close, but if you position it as, here's some information that might help you do your job better, that's more welcoming than, hey, I realize this is top of the market, but I really need you to hit this number. So if that helps.
Awesome. Well, thanks again, Joe. Thanks everybody for staying. I appreciate your time, and we look forward to the next one. And I put Joe's email address in the chat. Joe, do you want to give us your phone number? I'll put that in there as well. Not the lenders on here are going to be calling you, of course.
530-304-8471.
Perfect.
So that's something else. If a lender has a question, and it's not my appraisal, I'm willing to talk. So I'm good friends with a lot of the lenders who are members and active with the Yolo Association. If you guys have a question and you get an appraisal back and you're not sure what the appraiser did, give me a call, and if I can help, I'd be happy to.
Oh, we really appreciate that, Joe. And again,
but if it's my deal, okay. All right.
Awesome.
Thanks a lot. I got some divorces to write, so I'll see you guys soon.
And good luck with it, and we look forward to seeing everybody next time.
Bye.